Ladies and gentlemen, good day and welcome to Prostarm Infosystem Limited for Q4 and FY26 earnings conference call hosted by Arihant Capital Markets Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rohan Baranwal from Arihant Capital. Thank you, and over to you, sir.
Hello, and good afternoon to everyone. On behalf of Arihant Capital Markets Limited, I thank you all for joining in to the call into the Q4 and full year FY26 earnings conference call of Prostarm Infosystems Limited. Today from the management, we have Mr. Ram Agarwal, the Chief Executive Officer and Full-Time Director of the company, Mr. Abhishek Jain, the CFO of the company. So without any further delay, I'll hand over the call to the management for their opening remarks. Over to you, sir.
Good afternoon to everyone. I am Ram Agarwal, and a warm welcome to all of you for joining our first ever earnings conference call for the fourth quarter and the financial year 26. For some of you who may not be familiar with the company, let me begin by giving you a brief overview of the company. After that, our CFO will take you go through the financial and the operational performance of the period under review. Prostarm was established in 2008 with the objective of becoming a power electronics solution provider. Over the years, we have evolved from being a specialized equipment supplier into a comprehensive power solution company with strong manufacturing and service capability. Today, we focus on designing, manufacturing, assembling, and servicing energy storage and power conditioning equipment. Our product portfolio includes UPS system, solar hybrid inverter, lithium-ion battery packs, servo-controlled voltage stabilizer, isolation transformer, battery energy storage systems, and other power solution products, etc. In addition to our manufactured products, we also execute some solar EPC projects, system integration solutions, and provide value-add services such as installation, annual maintenance contracts, and rental solutions. We cater to diversified customer base, including government departments, public sector undertakings, utilities, railways, infrastructure companies, healthcare institutions, BFSI, and industrial enterprises. Our ability to provide reliable and customized power solution has enabled us to build a long-term relationship and establish strong credibility in the market. To support this growing customer base and strengthen our execution capabilities, we have continuously expanded and upgraded our manufacturing infrastructure. As part of strengthening our manufacturing footprint, we currently operate 3 manufacturing facilities. 3 of these facilities are fully operational and commercialized, including 2 in Pune, focused on UPS and related power conditioning products, and a lithium battery pack in Navi Mumbai. In addition, we are doing CapEx for 2 more facilities that will significantly enhance our capabilities. We are setting up 1.2 gigawatt-hour battery manufacturing facility in Jharsuguda, Haryana, which is nearing commissioning and is expected to become operational at the end of Q1. The facility is expected to substantially enhance our manufacturing capacity for large-scale energy storage solutions and strengthen our execution capabilities across both utility as well as C&I projects. Further, the Gujarat expansion project for our manufacturing UPS systems ranging from 1 kV to 600 kVA is progressing as planned and is aimed to diversifying the product portfolio while strengthening the company's presence in the power conditioning segment. The facility is now expected to become operational by Q2 financial year 27. Earlier, commissioning was targeted for Q1 financial 27. However, timelines were impacted due to ongoing supply chain disruptions. These expansion initiatives position us well to cater to the growing demand for advanced energy storage and power management solutions, while enhancing our scale, execution capabilities, and market reach. During financial year 26, we continue to strengthen our presence across key business verticals and secured several prestigious orders from leading organizations like Adani, Karnataka Power, Bihar Power, L&T, West Bengal Medical, South Central Railway, Steel Authority, and India One, among few. Supported by a strong order book and a growing bid pipeline, we remain confident about our medium to long-term growth prospects. While the ongoing geopolitical situation in West Asia created certain temporary supply chain and execution-related disruption during the fourth quarter, we believe the long-term demand outlook for reliable power backup and energy storage solution remains very strong. Increasing focus on grid stability, energy resilience, renewable integration, and localized manufacturing is creating significant opportunities for companies operating in the power, electronics, and energy storage ecosystem. With our diversified product portfolio, expanding manufacturing capabilities, pan-India presence, and a strong execution track record, we believe Prostarm is well positioned to capitalize on the emerging opportunities. We also continue to focus on operational excellence and technology integration across the organization. Implementation of SAP B1 and Salesforce platform is progressing well and is expected to further strengthen the internal controls, operational efficiency, customer relationship management, and service responsiveness. Overall, FY26 has been a year of strategic expansion, capability building, and the strengthening of our operational foundation for the next phase of growth. With this brief overview, I would like to request our CFO, Abhishek Jain, to share the financial highlights for the quarter and the financial year. Over to you, Abhishek.
Thank you, Ramji, and good afternoon, everyone. As I am not keeping well, Chandran Chaudhary, our finance controller, will take you through financial and operational highlights.
Okay, sir. Good afternoon, everyone. This is Chandran. Let me take you through the financial and operational highlights for the fourth quarter and the financial year 2026. Operating revenue for the quarter stood at rupees 105 crore, representing a growth of 27% year-on-year and degrowth of 35% sequentially. During the quarter, execution timelines were impacted by temporary supply chain disruptions and manufacturing challenges caused by limited gas availability arising from the ongoing geopolitical situation in West Asia. As a result, certain project executions scheduled for March were deferred and are now expected to be executed during quarter one of FY27. EBITDA for the quarter stood at approximately 11 crore, reflecting a year-on-year degrowth of approximately 3%, with EBITDA margin of 10.43%. Profit after tax for the quarter stood at approximately 8 crore, representing a growth of nearly 16% year-on-year, while PAT margin stood at 7.56%. Margins during the quarter moderated compared to the previous quarter and year, primarily due to the margin profile of projects executed during the period. Given the project-led nature of our business, margins may fluctuate on a quarterly basis depending on project mix, execution timeline, and revenue recognition. Nevertheless, we remain focused on improving operational efficiencies and maintaining healthy profitability over the medium term. For the full year, operating revenue stood at rupees 386 crore, reflecting a growth of approximately 10% year-on-year. Revenue growth during FY26 remained relatively moderate, primarily due to subdued execution during Q4 of FY26, which has historically been the company's high-performing quarter. On the margin front, EBITDA margin moderated by 98 basis points to 12% in FY26 compared to 12.98% in FY25. This was primarily driven by an increase in procurement cost along with higher employee investment undertaken to strengthen execution capabilities and to support future growth. Employee expenses increased from 22 crore in FY25 to 29 crore in FY26, while employee strength increased from 425 to 470 during the year. These investments were made in line with our long-term expansion plan and growth ambition. Profit after tax stood at around 33 crore, reflecting a growth of approximately 14% year-on-year, while PAT margins improved to 8.55% as compared to 8.24% in FY25. On the working capital front, working capital level increased to 83 crore in FY26 from 64 crore in FY25, while working capital days increased to 185 days from 68 days in FY25. This was primarily driven by higher receivables, strategic inventory buildup, supplier advances aligned with our strong order pipeline and business expansion initiatives. A significant portion of the increase in receivables was attributable to large project executions completed towards the end of Q4 of FY26. Collections against these receivables have already commenced in Q1 of FY27, and a substantial portion is expected to be realized during the current quarter. As a result, operating cash flow during the year remained temporarily impacted due to timing difference in collection and working capital deployment. However, supported by a strengthened post-IPO balance sheet and liquidity buffer, including fixed deposits of over 102 crore, the company remains well positioned to comfortably manage its near-term working capital requirements. Further, the company's balance sheet strengthened considerably during the year, with the long-term debt reducing from 3.4 crore as of March 25 to nearly 80 lakhs in FY26. Consequently, the company is now effectively net debt-free company, further enhancing our financial flexibility going forward. On the order book front, the company continued to witness healthy business momentum across key segments during FY26. As of end of FY26, our executable order in hand stood at approximately 1,106 crore, along with the additional L1 orders of around 96 crores, taking the overall order book to approximately 1,202 crores and providing strong revenue visibility for the coming quarters. Additionally, bids aggregating approximately 257 crores are currently under evaluation, which further strengthens our medium-term growth pipeline and execution visibility. Looking ahead, while geopolitical uncertainties may continue to create temporary supply-side challenges, we believe the long-term demand outlook for power backup and energy storage solutions remain robust. Supported by our expanding manufacturing capabilities, stronger order pipeline, and improving execution visibility, we remain confident about the company's medium to long-term growth prospects. With that, we now open the floor for a question and answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Paras Chheda from Purple One Vertex Ventures LLP. Please go ahead.
So just first question I was trying to understand.
I'm sorry to interrupt, Paras. Can you use your handset mode, please?
Yeah, please give me a moment. Yeah, please give me a moment. I'll just come to the better. Yeah, am I audible now?
Still, we are unable to hear you. There's a lot of disturbance from the side.
Okay. Yes, sir. Sir, my first question was with regards to the receivables that has shot up tremendously, over this Q4. How do we look at it, sir, and what proportion of this? I just heard that a significant part of this will be covered in Q1 or received. So what percentage or, is received in Q1, and how do we look at the receivable scenario as of now? That's the first question.
Right. Thank you, Parashji, for the question. Yes, you are right. The data stood at around 254 crores. This is majorly because of one major order being executed in third quarter, and which was completed by fourth quarter. And receivables against that has already been started. It was around 158 crores of execution on gross level. Data is always on gross. So on gross level, 158 crores of receivables stood for that figure. And majority of this would be collected in the quarter one. So you would find a significant improvement in data in quarter one. Secondly, would also add here, out of 254 crores, if you remove 158 crores of receivable, then the total data is around 96 crores against the remaining billing that we have done. And even on the same line, if we reduce from our net worth, from our turnover of 385 crores, the 134 crores of net revenue from this project, then it is 252 crores. If you work that, the aging would come down to 90 days, as against what is coming as 241 days. So it is basically just skewed because of one particular revenue being booked, and major realization would be in quarter one.
So the realization you confident will be done in Q1 of this.
Right. Something can spill over, but majority would be collected in quarter one.
Understood, sir. And sir, just, over the last con call, the general discussion or the indication was that for in FY27, we would probably turn operating cash flow positive.
Right.
So are we still on track for that guidance continuing?
Right, so Parashji, we are still on track of that. We told by quarter 3 of current financial year, you would find that improvement. Even in the current year, if you look at the cash flow being negative at around 48 crores, it is predominantly because of higher data. Even we are on the expansion mode, and we have given advance to supplier for procurement of materials, considering the current market conditions. So that is around 20 crores. So all those things would start falling in place. We are tying up with the dealer and distributor model, which we have specified earlier, and ease out the revenue model on a consistent basis. All this factor would help us to bring down the cash flow from negative to positive level.
So on an annual basis for FY27, probably we will still be positive from operation.
Yeah, because you have to give us some time to settle with that particular obscure, which we told earlier as well. This year we are expecting we would have signed for that.
Right, sir. So for FY27, the working capital requirement was guided at about 200 crores, last time around. Now, can we probably meet that with, whether some sort of equity dilution will happen because, in internal accruals and debt can meet quite a part of that, but would we still go for equity?
Paras, you just missed out on your last part.
So I was thinking our working capital requirement was indicated at about 200 crores for FY27.
Right.
Over the last call. So now a large part of that can be met with internal accruals and debt maybe. Are we planning to go for equity dilution this year to meet our working capital requirement?
No, as such we are not planning for it. For equity dilution. Right now, we are in a position where if any requirement is to be done on the working capital side, it can be made from the bank sources or our internal accruals.
Achha. No dilution is under plan.
Yeah. And you would not have seen our dilution as of now. We are still at around 73% holding.
Understood, sir. Understood, sir. The best project that we have, which was under the developer mode, have we decided to sort of, hive them off and get into the DPC mode, and what kind of project IRR do we expect on that if we continue with the developer mode?
And this, yes, we are looking for hiving off both the projects. But currently, if you are aware, there has been too much of disruption in the market with lithium price being moving and China current with West Asia, what is happening. So that is somewhat, and dollar appreciation. So there is some gap to it. But yes, we are looking for hive-off. We are speaking to few of the companies for hiving of these projects. Here, only thing is that EPC part would be done by Prostarm. So that part you would find in terms of the profitability coming into books for the company as a whole.
Right. So we are clear
I'm
that
sorry
we
to
not.
interrupt, Paras.
Yeah.
You may please rejoin the queue for more questions.
Sure, fair enough. Yeah, fine.
Thank you. We will take our next question from the line of Jainam Ranka from HIC. Please go ahead.
Am I audible?
Yes, sir, you're audible.
I just wanted to know the EBITDA margins in the different business segments, especially in the build to operate and EPC segment. And my second question would be what would be the asset turnover ratio in your BESS segment?
Right. First, I would answer your asset turnover ratio. See, the total CapEx that we are planning up is around 25 CR for the BESS capacity that we are adding. And that factory has a potential of generating revenue of around 1,000 crore. So asset turnover ratio is always very, very high. Because it's an assembling plant. It is not a full-fledged where we are doing cell manufacturing. Now, your first question was about the EBITDA margin. We are actually not able to derive individual EBITDA margin, considering it is order-to-order based. There's always a difference in the margin that we generate. Plus, products are also intermingled. I mean, transformer goes to the UPS goes with, and servo is also being added. So always there is a cross products which get sold. However, on an overall basis, EBITDA margin is always in the range of 12 to 13% on a year-on-year basis.
Okay, thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, kindly limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. We will take our next question from the line of Archit Agrawal from Step Trade Capital. Please go ahead.
Hello.
You're audible, sir. You may please proceed.
Yes, sir, my question is about the margin. Sir, what is the reason for this sharp decline in this margin for Q4?
In quarter four, there's 2-3 factors to it, Archit. One is about our always margin profile varies from order to order. So in quarter 3, if we have booked some good margin order, then it would have a different margin mix. And same way in quarter 4, it was not on the similar line margin order that we had executed. And that's the reason. But year on year, if you look at it, then the PAT percentage has gone up to 8.55% from 8.23%, which always in our commentary we deliver that you have to look at ourselves on a holistic basis, because it is not quarter to quarter which arrives at the margin profile. Because orders sometimes it is at a very good margin, some orders are at the lower margin. So mix of it decides about the margin profile for it. And what's the next question? Another reason for it is that there has been significant increase in our employee cost because of the expansion that we are undertaking. So that our employee cost has gone up to 29 crores as against 22 crores. And in similar line, we have added high number of employees as well. So, and in similar line, even our
Hello.
Hello. Yeah, and even our cost of production has gone up from 72.2% to 72.78%. This has been the key reason for increase in the higher cost. And as you are aware, there has also been a dollar appreciation in last 3 to 4 months. It has been very, very volatile. So this is also to some extent has impacted our cost of production, because we are not able to pass on the entire cost to our end customer.
Okay. So if we even take the average net margin of last few quarters, so it comes around 10%. So considering the effects in this quarter, I mean rupee depreciation and the cost of goods sold increased this quarter. So can we expect the same level of margins in coming quarters, or will it be back to normal? mean, 8 to
EBITDA
10%.
margin would be there in the range of 12 to 13%. However, there can be a short-term interim disturbance for us because of the cost which has gone up and other costs also which has gone up. So that would to some extent impact the margin profile. But since we take many orders as well with very, very high margin, so overall, if you look at the complete profile for the YOY basis, it would be at around 12 to 13% EBITDA margin. And we have done this in the past as well, even in the current year, we are doing the same. So you would not find, you would be comfortable. 12 to 30% of EBITDA margin would be maintained.
Okay. And my next question is about the order book. So you have said that you will execute the base order of around 40 crore in this quarter.
Right.
So is it achieved or still pending?
In this, yeah, in quarter one, we would do that best order of 40 crore.
No, but it was achievable in this Q4 quarter.
Yes, it was achievable in Q4. That is the reason why our revenue has been subdued, or else we would have done a much better revenue. Because of this West Asia disturbance, our supply chain also got disturbed, and therefore the billing was not able. We were not able to execute the billing. Now we are getting the material ready, and the execution is going to happen in quarter one. Or else our revenue would have been around 430 plus crore. There has been a disturbance in always last quarter becomes a very, very critical quarter. And since mid-Feb, you would have seen a big disturbance from China. Freight movement has been very, very reserved. So supply chain was disturbed, and even in local level, we were not able to do the fabrication because we require gas for undertaking the fabrication job. So we were deferred on the fabrication part as well, which resulted into deferment of billings for us in quarter 4.
Okay. And what will be the guidance for FY27?
For FY27, you would find minimum 25% growth that is there on the card. If you look at my order position, just to give you a very, very brief highlight, out of total order of 1,200 crores, if you remove the best EPC, best developer category, the remaining revenue is around 330 crores. Plus, other than this, we have a channel business which has not been considered here. It is around 100 crores per year. Last year, we did around 107 crores. So if you add that, it comes to around 450 crores already as on today. So minimum 25% growth is there with us, for next financial year. Apart from whatever additional business that we keep, that we generate and orders that we take for the full financial year.
Okay, and any steps taken for the supply chain issue, like that?
I'm sorry to interrupt, Arjit. You may please rejoin the queue for more questions.
Okay.
Thank you.
I will do so.
We will take our next question from the line of Priyansh Meri from NGP Family Office. Please go ahead.
Hi, sir. Good set of numbers. So my question is on the current 4 different capacity we have. What is the highest peak utilization revenue potential that we have across the 5 facilities? And also, why the utilization has been low for this year? If you can give some color on that.
Yeah. Highest capacity would be from the Jhajjar plant. It's a 1.2 gigawatt hour factory. So it has a potential of generating revenue of around 1,000 crore from that particular unit. So that's the biggest, highest turnover which can be there out of the 5 facilities. Now, with respect to your question about the capacity utilization being lower, in earlier commentary also have mentioned that we are not only predominantly dependent only on our factory part for the production. We are also importing from China, which is then customized and then being sold. So we use our factory to the area where there's a high-end customization required. Rest we are able to do from our job worker for servo, job worker for isolation transformers, and our known resources for manufacturing of UPS. So if you look at holistically, the capacity is not constrained. Revenue, whatever order that we take, we are in the position to build up revenue from our own sources in in-house capacity, plus my vendors, my subcontract manufacturers from whom I can do the procurement.
Understood, sir. Sir, the current order book that we have, will it be executed within 12 months from now? And also, on the capacity part, sir, you mentioned there's a peak one. Can you also give us some color on the maximum revenue across all of this facilities?
Maximum revenue?
Yeah, like 100% utilization. What is from our existing facilities, right? Without any CapEx, what could be the maximum revenue that we can see, maybe 3 years or 5 years down the line? I want to understand the maximum revenue from our existing plant.
I see. Hello?
Yes, sir, you're audible.
Like this, it will be a bit difficult to answer, but however, I would try to frame it. Jhajjar factory has a capacity of generating revenue of 1,000 crores. And the UPS factory, if you're aware that we are coming up with expansion in Gujarat, which would be more like a assembling line for UPS. That plant has the capacity which can go up to around 3,000 to 5,000 units per day. So even if you take 3,000, roughly around 9 lakh unit can be produced there. So that has the capacity of giving you around 506 to 600 crores of revenue from Gujarat facility. So this two added up. So majority revenue would be coming from this two facility. Meaning if you look at it, if I do 100% only manufacturing from my factory and at full-fledged operations, the revenue from all facilities together can be roughly around 1,700 to 1,800 crores other than import that we do. If I do only 100% localized based business only.
Understood, sir. Sir, next part of the question, will be able to execute whole order book in next 12 months?
Yes. Except for the best on the developer model, because that's a rental model with around 63 crores of rental per year. The rest of the entire 336 crores, what I have told you, would be booked in the current financial year, as well as the channel business of around 100 crores minimum what I've taken. So that would be executed in the current financial year. So around 430 is what I'm already mentioning would be done in the current financial year.
Understood, sir. Thank you. Thank you for this opportunity, sir.
Thank you. Next question is from the line of Ayush Jain from Equity Advisors. Please go ahead.
Hello.
Yeah.
Hello. Yeah, a couple of questions, sir. Your guidance is 430 crores for FY27, right?
If you could take as a roughly order in hand, 336 is the order in hand, plus channel is a regular base business. I mean, it's without, you don't have a PO which can accumulate.
Okay. So
that's around 100 crores.
70, 80,
yeah.
100 crores you're saying, for 530 crores we can expect actually.
336 plus 100 crores is...
Okay. 336 plus 100.
Yeah.
430 crores roughly, na? Okay. So second thing, so our business is of a lumpy margin business, right? So what can be the base EBITDA margin that we should consider by formulating our financial models for your company? The base EBITDA margin.
Base EBITDA, if you take, that should not be less than 10%. Should not be less than that.
Should not be less than 10%? Okay. And third thing is, if we have unutilized capacity, you were saying that you people get things, contract manufacturing from outside, right? If we have unutilized capacity, then what we can expect in future, in suppose 1 or 2 years, when will be the capacity get utilized to the tune of, say, 70-80%?
Yeah.
So I'm asking just for the sake कि जो capital expenditure हुआ है वो better utilize कब हो पाएगा?
Yeah. अच्छा, पहला बात है कि जो capital expenditure होता है, it's very small. If you look at the overall picture, even when we had done our expansion in Pune, the cost was very low. When we did 100 megawatt hour expansion for lithium, the cost was around 3.5 to 4 crores. Is a total capex for, because it's an assembling line. If I go into a more backward integration, then your cost gets increased. And Jhajjar
Correct.
plant, the capacity, the cost is around 25 crores.
25 crores and you can achieve 1,000 crores.
And even for
business,
Gujarat,
right?
the overall project cost is not more than 5 to 6 crores. So you can very well evaluate the cost is very, very low in terms of the turnover.
Your asset turnover ratio is higher. You are
It's always
saying
high.
the asset
But
turnover ratio is
yeah, it's
greater
always
than
high.
8, mid-teens,
Yes,
10,
yes.
11.
It's very
Okay.
high. In fact, it's very
It's
high.
very high. It's very high.
But
Okay.
however, now to answer about the capacity realization, yes, you would find more capacity realization getting increased. Even if you look at the capacity realization has improved for us as compared to last year from our factory. And with the Gujarat plant coming up, what we are planning earlier, like UPS that were imported on an as-is basis, then which was again assembled, aligned and accomplished. Now it would be more on the SKD side. So we have to do more value addition at our factory. So it would have more manufacturing angle to it. So you would have more factory capacity utilization for the UPS part, which is our core product.
Okay. And my next question is on the line of ESOPs. Do you have any other ESOPs commitment lined up in next 2 years?
See, this is somewhat difficult. The total pool of ESOP is 40 lakh. And as of now, it is around 13 lakh been issued and something around 3.5.
How much is issued? Sorry, sir. Pardon, I didn't get it. How
Sorry?
much is issued now?
Just a minute.
40 lakhs is your total pool?
40 lakh is the total pool. And
Okay.
out of which ESOP already issued is around 13 lakh. And roughly around 3 lakh plus is what we have. 30.26 is what is outstanding as on March 26. And we have additionally given up.
Sorry.
Yeah.
30.26.
13.
13.26.
6 is the current outstanding, and fresh ESOP has been granted for around 3.22 lakh has been granted. And there can be more ESOPs going forward because we would be taking more talent from the industry. So for acquisition of talent, ESOP is always a very, very good tool to acquire.
Okay. And my last question is on the line. What's your market scenario right now for UPS business? Like it's coming all the way from only the government business, or you're getting private
It is coming from mix of all private and government everywhere. See, if you look in our total revenue, 43% of revenue is from government, rest is all from private.
Okay.
And
the payment cycle is the same for the two businesses? For
Sorry?
the two sanctions? The payment cycle is the same?
Yeah, payment cycle is same.
Payment cycle is the same. Okay. Thank you, Abhishek.
Yes, thank you.
Yeah. Thank you so much.
Thank you. Next question is from the line of Paras Chheda from Purple One Vertex. Please go ahead.
Yes, sir. Best project?
I'm sorry to interrupt, Paras. We are unable to hear you.
Sir, do you expect our developer project to be executed now? Of course, we're looking
Paras,
to high
can you please use your handset mode? We are not able to hear you.
Okay. Am I audible now?
Yes,
Yeah,
Paras,
please
you're
proceed.
audible.
Yeah. So I was saying that, when are we likely to implement or execute our developer project? Because it's probably not in FY27 completely. When do we likely expect the completion of that project? Or, if we are looking to hive off, will it be a sort of a one-time gain kind of a thing? And what's the project hire on that, sir, if it comes to execution?
Project side currently is coming at around 10 to 11% on an overall project basis. However, regarding execution, Ramji would just highlight on that.
Yeah, Parajit, we are working very closely with few people to hive off our both projects, and we are too sure that we'll be able to hive off both projects. And if you talk of EPC execution, we are targeting Bihar to be done in this financial year for sure. Karnataka, there are some hurdles which, if it happens, then we will try to execute even Karnataka also in this financial year. But as we do not have control on the legal side issues of Karnataka, so Bihar is in our control. So Bihar will good for sure in this financial year.
Right, sir. Just last two queries, now, I mean, assuming, Jhajar facility is up and running from, let's say, 1st of July this year, what capacity utilization do we expect for this year?
This
And
year,
next
we are,
year?
this year we are hoping to touch 25 to 40% utilization in this financial year.
25 to 40%, and probably next year?
Next year we are very hopeful to touch 70%.
Up to 70%, right. And sir, what kind of growth rate do we expect on the UPS business now?
UPS growth rate we are expecting even more better, as we are now coming up with Ahmedabad plant, where we'll have a more focus on the variety of UPS. So we can assume a good growth of in UPS business in next 2 financial years. Maybe more than 30-40% growth in next 2 years compared to last 2 years.
Understood, sir. And just last question, sir. What receivable days do we, sort of target to exit FY27?
In FY27, the receivable days will be something around, roughly around at 120 to 150 days.
120 to 150 days.
Yeah.
And we'll be cash flow positive, as we said, for FY27 as a whole.
We will be cash flow positive.
Understood, sir. Okay. Thank you so much, sir.
Thank you. Ladies and gentlemen, before we take the next question, a reminder to all the participants. Anyone who wishes to ask a question may press star and 1. We will take our next question from the line of Mrinal Patel, an individual investor. Please go ahead.
Hello, sir. My name is Kunal, and I want to ask you about our new facility of Haryana. Everyone is waiting for new facility BESS, and I have watched your NDTV profit interview where you mentioned about this BESS facility can generate 1,200 crore revenue per year at maximum pace. So please shed a light on this.
Good afternoon. This Jhajar factory, almost all our machines have come. It's going under assembly, and we are expecting that to be completely operational in this quarter. That unit would be ready in this quarter.
Okay, sir. Maximum revenue can generate in the FY27?
FY27, what already Ramji told earlier, it would be around in the range of 20% to 25 to 40% would be the capacity utilization that we are expecting from our Jhajar factory.
Sir, yes. But in BESS new facility?
Yeah, from new facility, yeah.
Yes.
Yes, this is from the new facility what I mean.
Yes, only standalone BESS facility where we can generate maximum revenue from that Haryana facility.
From Haryana facility, we are targeting 25 to 40% in current financial year.
Okay, sir. And currently in H1 FY27, all companies are waiting for DISCOM's approval for our solar plants. So in our Gujarat, maximum EPC players are making solar power plant, but can't get approval from the DISCOMs. So what is the reason behind that?
This is a policy decision. Maharashtra has taken decision so fast to implement BESS in all the solar plants, and they have implemented immediately, but some cases have gone against them in the court and still under sub judice with the court. So Gujarat also is working on the same line. So sooner or later, to standardize the grid stability, BESS is important, either for the new project or for the existing project, solar project. So sooner or later, this will come up, BESS energy storage plant, and lot of discussions we are doing with the existing EPC players to install BESS in their plant.
Okay, sir. In FY27, solar players making the 40 to 45 gigawatt per year basis solar power generation or solar power installation, but we already crossed 170 gigawatt solar module manufacturing and after June 2026, ALMM Part 2 is coming. So is that any problem solar power generator can face?
I cannot say much on this segment because we are not into this segment, but similar some corrections or some limitations also coming from the government side on our battery energy storage also, where they will announce the ALBM, approved list of battery manufacturers. So I don't see as a disturbance, I just see as a supporting from the government to the local manufacturers so that Chinese metal come to India as less as possible.
Okay, sir. All the best for FY27.
Thank you.
Thank you. Next question is from the line of Archit Agarwal from Step Trade Capital. Please go ahead. Archit, your line is unmuted. Please go ahead. Archit, can you hear us?
Hello, am I audible?
Yes, you are audible. Please proceed.
Yeah. So on a multiple occasion, you mentioned that due to supply chain disruption, the company was unable to achieve the targeted revenue as was contemplated during the Q3 estimate, right? So can you elaborate to some extent which kind of the supply chain disruption that you have been facing and how margin dropped from Q3, as well as actually we want to know about that. There has been significant variance between the estimate that you have mentioned for during the Q3, right? So there are two things. One is the deviation in the Q4 revenue as compared to the previous estimate, and second thing is about the drop in the margin, right? So please throw some light and tell us little bit more so that we can come to know what would be your Q1 and which kind of the supply chain disruption that you are facing, right? Can you quantify as well as hello?
Yeah, I'll tell you. In Q4 last financial year, we were majorly facing the issues of supply chain in terms of the freight forwarding. The logistic movement from the China to India was one side. We are not getting the proper timely logistic support, and the cost of freight has gone up by more than 2x in Q4 compared to earlier. First. Second, in last 3 months, the dollar has appreciated almost close to more than 10%, 3 to 4 months. So this is the second reason. Third, due to geopolitical issues, China knowingly they have removed the export incentive on BESS from 1st April. So the cost of all the material which was planned earlier, which was order placed earlier, for 1st April, the cost goes up. So either the supply in China, they are cancelling the old order or they are passing the cost to us. So these are the major reasons it has affected in Q4. But now if you talk of Q1 and further in this financial year, it may not affect much because already it has been accounted. We have already taken the hit. And now whatever project or bidding we are doing, whatever new sales we are doing, all the price effect has been taken into account. So the hit what has been done in the last financial year and the initial of Q1, all has been more or less has been taken into account. So we are now well placed to take this price increase and the other challenges for the rest of this financial year.
Actually, all these reasons that you mentioned, right, that is the, I think, macroeconomic issue, right? That is the problem of entire India.
Correct.
So, sir, actually, this problem India has been facing since 15th March, right? So, last 15 days may be affected, but, sir, I am talking about entire Q4 and I am talking about entire FY26.
No. 15 months was severely affected. Whole problem was going for last January onwards because the container movement was not happening. So this was only the trade people or the business people will come to know. In the open market, it was not very much known to the general people. 15 March, when the complete disruption has started, then only we all come to know. So, and because of this, lots of big corporate has postponed their CapEx in Q4. Like Adani, we have been asked to do in Q1 of this current financial year. Otherwise, we were ready to build them in the last financial year.
Hmm. Hmm. So, sir, actually, see, what is my understanding? So, see, if you look at your entire annual set of number, right, for between FY25 to FY26, growth is very negligible, only 9%, right? It is quite low as compared to the industry as well as compared to your previous guidance. So, see, what I'm understanding, even if we consider last 1 month, you have been facing this supply chain disruption, right? Instead of 15 days.
It has not been done. I'm telling you. Last Q4, the last of Q4, generally our trend in last few years, if you see, our last month of the Q4 has always become a very big high billing month for us in the whole financial year. So we are having lots of orders in hand where we couldn't bill in Q4, end of the Q4. And all has been billing happen in this Q1 and Q2. This is the only main reason where everything was done in Q4 or last financial year and billing was not happened. So revenue is not booked.
Okay. And sir,
if you see our order in hand position of March 31st, then you will come to know what was the so high number of orders in hand was there with us, which we are billing in this Q1 and Q2.
Okay, so you mean to say Q1 and Q2 will be good?
Yes.
Okay. And sir, can you throw some light on the industry peers? Because, sir, we have not seen such kind of the drastic fall in the industry as a whole, because we are also tracking the same industry, right? So far as the peer is concerned, actually we notice the significant growth. Even there is there is a little drop or moderate margin in terms of the margin, right? So actually, industry is almost maintaining the same set of the margin, and if you look at in terms of the growth, so top line growth is there, right? But here in your case, it's quite different. So actually, I'm not able to understand the exact reason, and please quantify as well.
I'll tell you one example. Like we have a Adani order of around 43 crores in hand. Single order got delayed, postponed from Q4 to Q1. So in that 40 crore has hit us at the end of the Q4. Others you would have built and would have achieved around 440 crore turnover in the last year, which have given us a good growth in the last year. So only one order will get postponed to Q1 and we got a hit of 40 crore. This is I'm not talking in general, I'm talking specific. One order, single order has hit us 40 crore. And which we are billing now.
Archit, would add here more time. You would have seen all our declarations with respect to orders that we have been giving back to back. If you look at Adani, which we were not able to execute, SAIL we got the order of 7 crore, which we have not been able to execute. Southeastern Railway is around 13 crores that we were not able to execute. So there has been a temporary disruption. Always, what happened in this industry, it's always it is having a depreciation benefit. We get good mileage in the month of March for the billing with respect to the revenue. So there had been some temporary resistance and calls subdued from the customer side. And the order that we had in our hand, that is also not getting executed. People were watching as to what is going to happen next. And you've been finally seeing the dollar movement coming up. Now you have mentioned about the costing part. In industry, you are watching other companies also. I am not pretty sure about it. If you are looking for the same line segment, not solar. If you compare a solar company, it's a different category. I am not a solar company. So we are into...
Actually, we are not comparing...
Yeah.
We are not comparing your company with the solar company, but there are a few set of the company. If you look at one of the segment is matching with your company, right? So far as that segment is concerned, actually we have not seen any kind of such drastic fall in terms of the margin as well as in terms of the revenue.
This particular amount which is there, which I told you, all this billing which has got deferred, if this would have been booked, then our numbers would have been much, much different. So you would have this impact in quarter 1 and quarter 2. And regarding the cost, I've already mentioned that since companies is on the expansion phase, we are coming up with facility in Gujarat and Chhattisgarh. Plus, we have onboarded many sales people. So our total employee cost has also gone up to 29 crores from 22 crores. This is in line with the expansion plan that we are lining up for the coming financial year. So this and plus the dollar composition, because the import and even the local procurement has gone up. So that has impacted to some extent on the margin. So it is not about one particular item having an effect. Something which has been done from the company side on the expansion part, which was somewhat toppled by the disruption which happened from fifth period onward, actually, I mean West Asia for it to take. Plus the expansion which the company has taken, uske liye jo company had taken expansion. So the whatever onboarding company has done from its side. However, the outcome of this would be that the coming year we would see a better quarter one and quarter two.
Okay. So Abhishek ji,
yeah.
Sorry to interject you. So, sir, we are on a 25th May, right? So almost, I think 60-70% of the Q1 is also completed, right? Still, actually, there is no conclusion so far as this Middle East conflict, right? So how do you see Q1 number? So will you say same thing at the end of the Q1, or there will be improvement in terms of the margin?
Quarter one of this financial year, you would see a revenue growth as vis-a-vis the quarter which was there in quarter one last year. We find a growth.
Okay.
Yeah,
so,
there is a short growth to it.
Okay, so means you mean to say there will be not much impact of this significant supply chain disruption in Q1 so far as the margin is concerned.
Now we would be in position to take those billings. Now we would be in position to take it.
Okay. Yeah. Okay. So what would be the margin guidance for Q1 and Q2?
You take the EBITDA margin would be in the range of 12 to 13%, and PAT percentage would be in the range of 8.5% to around 9.5%.
Okay. Understood. Okay, sir. Thank you.
One more, Archit, if you look on an overall basis, I've already mentioned that around 430 crores of order is already there, including channel business. It's already there because this is other than whatever business we generate, and not even including the best developer business. We are not considering. So this much is minimum revenue. So you can always multiply and you can do those maths as to what roughly number should be for the company.
Okay.
That is good.
Okay. Understood. Okay, sir. Thank you. Yeah, thank you.
Thank you. Ladies and gentlemen, we will take that as the last question for today. I now hand the conference back to the management for closing comments.
Yeah. Thanks all of you for participating in this earnings conference call. If you have any further questions or would like to know more about the company, please reach out to our investor relations manager at Valorum Advisors. Thank you all of you.
Thank you very much. On behalf of Arihant Capital Markets Limited, that concludes this conference. Thank you all for joining us today, and you may now disconnect your lines.
Thank you.